Afternoon. It is just gone 12:30, and we look forward to taking you for the next half hour through the latest developments on the BizNews Global Portfolio. I'm Alec Hogg, and with me in studio is
Stuart, Lowman,
the one and only team from BizNews. We're coming to you from the richest square mile in Africa. Our offices here at the Johannesburg Stock Exchange, which were quite an interesting place, I believe, earlier this week. Although
yes.
we weren't here. We were all working at home.
I think we're lucky to have that remote working facility, Alec, because we had a sea of red running through Sandton.
Something like 10,000 EFF, 4,000.
40,000.
40,000?
Yeah.
Serious?
That's what they said.
Oh, Reuters said 10,000. So depending on, I suppose Julius would have said 400,000. Anyway, Julius sat in that very same chair that you're sitting in now. This is Julius Malema. He was a lot more polite that day than I guess he was when he came to the JSE. Anyway, we're not talking about the JSE. We're talking about the BizNews Global Portfolio. And the reason we decided to go global a year ago is related to something that happened, I guess, this week at the JSE. We feel that the country is being poorly managed economically. As a consequence, we're very strongly of the view here at BizNews that the rand will weaken, not strengthen. We changed our minds from a past approach where we would always support reinvestment of capital into South Africa. Now we think that it's the right thing to do to actually bring this government to its senses by investing where you can get the best return on your money, and it is not in this country, unfortunately. Anyway, that's what we decided to do with the BizNews Global Portfolio, and it's been a good move so far. Let's go into where we are at the moment. I'm going to get my technologically challenged right finger clicking, and away it goes. There's the portfolio. If you have a WebTrader account, you would recognize exactly what this is. The account overview. We started the portfolio on the 5th of December 2014, so we're coming up for a year. We're 11 months in. In US dollar terms, it's grown from an initial amount of $200,000 to $224,000. It is always a high risk to do a portfolio like this because it goes into the public domain, so anybody can see if you're idiotic in your selections. We've been very fortunate in our selections over the year, as you can see here. But we did say from the outset that this is a portfolio where the period hold is forever. So just remember that. We're not going in to buy these shares on the basis that you trade them. We believe trading is for fools. We are investors, not speculators. And the portfolio overview there shows a reflection of exactly what we believe in. There is a big chunk of the portfolio is in the market overall, the Vanguard S&P 500 ETF. What that does is it mirrors the American stock market, and it has not done a whole lot in the past year, but it had a fantastic month. We'll bring you up to date on that in a moment. And then the individual share picks, which it's very easy to see when you have a look down at the profit and loss. The best performers by far were Amazon.com, which is up 88% in US dollar terms, over 100% in South African rand. Then a very good run for Alphabet, which is Google, the old Google. They've changed the name now. And then also a very good performance from Novo Nordisk in US dollar terms. Also in US dollar terms, we have had our other three holdings, Apple, Berkshire Hathaway, and IBM, are all below the price at which we bought them out in the portfolio. So it just reaffirms the view that these are long-term investments. Just having a look at the prices at the opening, as you can see, this portfolio began on the 5th of December 2014. Those were the cost prices. The idea was to have 1/3 of the portfolio in Vanguard, in other words, in the overall index, to then have 15% each initially in Google and Berkshire Hathaway, because two companies that we believe were the best in the world. We then, after doing a lot of analysis into Apple, decided to go with that one as well. So we've got 15% stakes in those three companies. 45% if you like in our three big stock picks, and then the smaller stock picks, Amazon, Novo Nordisk, and IBM, with 8% in each. So it's a very structured portfolio, 30% into the market overall, 15% each into Alphabet, Apple, and Berkshire Hathaway, and then 8% each into Amazon, Novo Nordisk, and IBM. We've been looking at a stock very carefully over the last month and a half, and are quite keen. I'm not absolutely sure yet. I think I'm not going to tell you even what the stock is, but we'll wait for it to come back a little, and then perhaps make the investment in it. But it has to be, remember, in line with the Warren Buffett way of doing business, which is what is the intrinsic value, or what do you believe the intrinsic value is of that stock, and then only buy in at a comfortable margin of safety. So we do our analysis, we find the intrinsic value, and then we would buy in 20% below the intrinsic value, which is all of the acquisitions in this portfolio have gone into that philosophy. Apple, incidentally, after its latest results, is trading at a 6 times EBITDA ratio, whereas many of the stocks similar to it are trading at 20 to 30 times. So I don't know why the market doesn't like Apple. We love it. If we had a even more aggressive portfolio, we'd probably be adding to it. There is the thing that matters for South Africans. If you have a look here down the bottom, you'll see the exchange rate on the day we began was 11.27 rand. Is what it would cost you to buy $1. It's now 13.73 rand. That has made a very easy, or rather it's given you a strong underlying performance if you have been investing offshore. The reason we've gone into the United States is that we believe that this is the economy that is best positioned for economic growth in the long term. There's many issues in other parts of the world, but the United States has a constitution, and it has a system which employs the most efficient, or allows the most efficient application of capital, the most efficient distribution of goods and services. People just can't get in the way. They allow the market to do the work, and the markets are just so much more efficient than individuals are, particularly because most individuals who get involved in this kind of thing don't even start to know what they don't know. You can send through questions to us. They are open. In fact, that's what you're here for, Stuart. Huh?
Yes, Alec. Just if the guys can, or ladies as well, please put the questions on the right-hand bar there. There's a questions tab. You just click open and send it through, and then I'll convey the message to yourself.
So you just type the questions in. Pretty simple.
Yeah.
All right. So the questions are open. There's the performance of the rand. We'll show you in just a little while, but it gave us 20% from a starting base. So the first idea, the first view was the rand is going to be weak. Let's get the money offshore. That was where we started, and that's been a very good view so far. The second view was to put that money into the various stock picks and the overall market. The overall market, as you can see, has gone up slightly. It's now 27% of the portfolio. It's given us a 24% return. So if you just take in your rands and put them into dollars, you've got about 22. The market as a whole, the US market as a whole, is 2% up. So you would have had a 24% return over that period. But look at some of these. Google, 63% in rand. Amazon.com, 129%. And then Novo Nordisk is 60%. In fact, we haven't got a single loser because of the impact of the rand. Although Apple, Berkshire Hathaway, and IBM are all below where we bought them in US dollars, in rand terms, we haven't had a loser. So the portfolio annualized, well, so it's 11 months into the portfolio. It's a 35% return in rand and 38% annualized.
Hi, Alec. We've got a question from Quibus. He just asked, what's the return in dollars, not the rand return?
The return in dollars is 12%, and that you can see from the previous graph, which is let's just go back. Oopsie, sorry, previous. It's pretty easy enough to click it, isn't it? There we go. If you were to take all of that together, we'll go into more detail later on, but the return is 12%, and you then would add 22%, will take you to 34, which is roughly 34, 35, around there. 12% in US dollars, which is comfortably outperforming the overall market, which is 2% up. Not too many portfolios do that. But please remember, we're not actually trading. This isn't a one-year punt. These stocks were carefully considered. They were invested in to be held forever. So even though Amazon's gone up 129% in rand terms, we're quite happy to stick with it.
Alec, just another quick question from Benjamin. He says he's 70 years old, and he wants to know how he joins, and what's his minimum investment required?
Benjamin, this is a facility that we do in collaboration with Standard Bank. Standard Bank have got a web trader service. So if you're a Standard Bank client, it's quite simple, I think, just to open a web trader account. In fact, it's very simple to open it. You can put up to R1 million into the account. It's always your money. And that's without having to ask for exchange control approval or anything. And then you can allocate that R1 million in the way that you want to. It's very, it's a very user-friendly back end. And congratulations to Standard Bank for actually having come in to assist in the way that they have to bring the world of investing to everybody in South Africa. So it's the same way as you would use a normal online trading account. You use it for the web trader, just gives you access to international accounts as well. There you can have a look. The rand profit since inception, or the rand dollar, is up 22%. So if you just put your money into dollars a year ago, from 11.27 to 13.73, you would have made 22%. And there are the other performances as well. Okay, I've just discovered something. You know, when you're used to using Apple your whole life, to have a Windows does become a little bit more difficult. I see there's Dion Martin. I see the question, what effect has dividends had on the portfolio? Well, there it is, Dion. We've had $2,300 receipts in dividends. It's about 1%. It's not exactly a huge return. Remember, we started off with $200,000 to begin with, so dividends have certainly assisted, but not in a big way. Interestingly enough, we got quite a nice dividend coming from Apple. That will be paid in November. They've just announced another dividend, and they'll be putting a lot of money into share buybacks as well. So a small input from dividends. Okay, moving on to the individual constituents of the portfolio. First up is Vanguard. Vanguard is our preferred S&P 500 route. The S&P 500 is pretty much the market for the United States. What they do is they take the biggest 500 shares and then they weight them in different ways. The S&P 500, the Vanguard index fund, which we invest in, VOO is the index abbreviation. It invests in those funds, and as you can see, it tracks the market just about. The correlation is almost 100%. The stock market in the United States has had a fantastic month, up by just around about 11% in the past month, and that has helped our performance as well, because if you go back to this point in time here at late September, early October, the market had taken an awful hiding. If you recall, there was lots of things happening around the world, including the Chinese stock market that had fallen completely out of bed. And that did have impacts. There were some who were panicking about it. We weren't. We were quite excited at the opportunity, and had we had more cash, we would certainly have invested there. For those of you who were at the last webinar in early October, which would have been around this point here, would have seen that you'd already bounced off the bottom, and in the period since then, the overall market in the United States is now just about, in 6 months, it's just about level to where it was 6 months ago. In the year as a whole, it's up by 2%.
Alec, just this question from Diane. If you want, this question on the admin side, if you want to realize your money offshore when you do eventually sell, as she understands that you need an offshore account from which to transfer funds to WebTrader. Is this correct? I'm not sure if we can answer that.
Diane, I think that's the question, and we can give that to Stuart, the other Stuart from Standard Bank, and to Brett Duncan, and let them handle it. So, Diane, if you would just drop me an email, alec@biznews.com, and I'll send it on to Brett and Stuart, and they will be able to give you the answer to that question. I see another one here from Benjamin Pretorius. Are you reviewing your portfolio from time to time? Benjamin, it's important to understand that this portfolio is, the purchase period is forever. So what we did to start off with was that we had 30% invested in the S&P 500, and the balance in our share picks, 6 of them. If we find a share pick that we think is better than the market as a whole, then we do have the facility, obviously, to sell part of the 30%, or now 27%, that we have in the S&P 500 index. So let's just say there was a stock, Twitter, as an example, which is another one that I've been looking at. If we think that the time is right to buy into Twitter, which it isn't right now, it's a little overpriced it seems, then we would sell 8% or about a third of our holding in the S&P 500 and invest that into Twitter. And so what this tells you is that we've still got three more stock picks that we can take. And at that point in time, if there is then something else that comes up that catches our attention, we would then have to make the very difficult decision to sell one of the existing holdings to replace it. But this is not a trading portfolio. This is not a portfolio. We don't go to sleep on it because we review it every week, every month. And clearly, I keep on top of what's happening in these companies. But every month, we would, through that period, be looking for other shares that we can hold forever. We do still have the capacity now for another 3 potential investments. But as you've seen, a lot of work, a lot of study went into the portfolio before we started off. And the only one that, in fact, that we've added in a year has been Apple.
Alex, I just got a question from Paul. He says, please correct my thinking if I'm wrong. Money is only made when the share is sold. Will you be selling and taking profit with the weak rand, or will the profit be reliant on the fundamentals of the companies in the portfolio outperforming the market and selling when they are perceived to be at full value?
I don't know who told you money is only made when shares are sold. That's definitely not. If you want to follow Warren Buffett's way, and remember, this is a Warren Buffett portfolio. We believe in the Buffett way. We believe do your research, do your analysis, hold the shares forever. What Buffett recommends people who own Berkshire Hathaway shares, what they should do, he says if you need to realize, if you need income from your Berkshire Hathaway shareholding, then have a look at the period that you need to generate that income in, and then sell shares in Berkshire Hathaway to realize some of that capital. So let's just use this as an argument. You're 70-year-old, you think you're going to live to 100, you've got $100,000 or say 100,000 Berkshire shares. You should be so lucky, but you know where I'm going with this. Then what you would do is you think you're going to live for 30 years. That means cash in 3% or sell 3% of your shareholding to realize the cash that you might need at that point in time. This idea of you don't make a profit until you sell, or you don't make a loss until you sell, is absolute bunk. Investing is not speculating. Speculating is what you do when you buy something hoping to pass it on to someone else at a higher price. Investing is you become a co-owner in the business. And co-owners in businesses that don't distribute dividends can realize their cash, can realize their capital by selling a small percentage of their shareholding to do that when they need to, in need. I hope that actually helps you, and certainly that's my philosophy, and that's the way Buffett looks at it. He's the greatest investor in the world and a person that I would recommend everybody reads more and more about. In fact, my new book is coming out in January. It'll be in print, in the print version. We're going through the editing of it right now, so it's a bit late for a Christmas present, but I'm sure it's going to help in the new year.
The post-Christmas blues.
The post-Christmas blues. Help overcome the post-Christmas blues. Let's look at Berkshire itself. As you can see, underperformed the market generally, continues to do so. This is a company that we still haven't got the quarterly results out from Berkshire, but what I can tell you was that Buffett bought more shares in IBM. He loves buying shares that are cheap. He doesn't like buying shares that are expensive. The same way you should look at your investments from a similar philosophy. He has, at the moment, showed a loss in his portfolio. The portfolio of Berkshire is about $106 billion at the last count. $106 billion, started at zero, by the way. He's shown a loss there of $1.7 billion on paper on IBM, but he would never look at that. He would just say, yippee, IBM is cheaper, let me buy more. And that's the strategy and the philosophy that Buffett uses, the one that we should be using too. In fact, we did that with Apple. When Apple dropped to around $110 a share, we decided to buy more. We changed our rules and put an extra 8% because it was such a great investment, and I think it's still very good at the moment. There's a six-month graph, not that poor performing relative to the S&P 500 index, but as you can see, it's been a good October, a very good October, even for Berkshire.
Alec, just quickly, it's from Denver, looking at the new age stocks, the Teslas of the world, do you see any potential in Elon Musk's Tesla or biotech stocks?
I don't know anything about biotech, Denver. Sorry, I can't help you there. I know there are people who are experts in that field, jumping on the bandwagon. I don't know. So that's another thing that Buffett teaches us right from the beginning. Stay within your circle of competence. It's outside my circle of competence. I will research and I will try and find out more about it, but at the moment, sorry, can't help you there. Elon Musk, Tesla, I'm still looking at it and I'm still researching it. I love the story. I love the fact that he's South African. I love the fact that he's just this amazing entrepreneur. And I love the fact that his cars score 103 out of 100 in their research, in the reports of magazines. It's impossible. How do you score 103 out of 100? Well, Tesla have done it. The Tesla story is one that is just going to get better and better, but you've got to find the right entry point. So I love the company. The entry point into the shares at the moment is a bit higher for my comfort. Remember, what we need to do is you get an intrinsic value, or at least a view of the intrinsic value, and then make sure that you only buy in at a 20% or higher discount. There are many great shares on the market, many great companies on the market, but if they're intrinsic, if you can't get that margin of safety, then you're not protecting it. You don't have that buffer against something that could happen. Even Berkshire Hathaway in 1 year dropped by 50%. 50%. If you didn't have that a margin of safety, even on a wonderful stock like that, you could, in an emergency, being forced to sell it, you could lose money, and that's not that's not what we're trying to do here. Moving on to Google, or now called Alphabet. Well, what can we say about this company? We bought into it at a time that it wasn't that popular. In fact, for some months, our shareholding in Google was below that of the market as a whole. But now the market loves Google, just absolutely adores it. The latest set of quarterly results that came out saw the shares hitting a new high. It's now also, this is Alphabet, it's called Alphabet today, it's structured like Warren Buffett's Berkshire Hathaway. It's now in a position where it's going to start with share buybacks, going to be spending $5 billion, or it's got approval to spend $5 billion on share buybacks. It just shows you that the model is mature. The money is just pouring in. There's no way that you're going to displace Google with anything we know in the area where it's strong, which is in search and in online advertising. It's also making some very interesting investments into other spaces, like the space that Elon Musk is in with electric cars, although Google is much more on the basis of self-driving cars. It's the reason why the market loves it is that they appointed Ruth Porritt as the financial director. She came from a Wall Street bank, and she has applied the disciplines from a financial director's perspective that Wall Street loves. Up until the time that Ruth came in, Wall Street was a little bit dubious about whether Google could ever, or Alphabet as it's now called, could ever claw back the techies and get them to spend less. Well, she's managed to do that, and every time the results have come out since she's been there, that's for the last 2 quarters, the market has found a reason to push these shares higher. They are at an all-time record at the moment, and as you can see in the last 6 months, they put on 31% as against the market, the NASDAQ, which is up 1.4%. Google is one of the market's darlings.
Alec, just quickly, David Melville, he's just looking for an allocation in terms of sectors, industrials, financial resources, because he says it looks very bearish on resources, which is...
Sorry, David, it's nice. I'm glad you're joining us here. We're not doing that. We're just not going to do that. To try and read the big picture is you need more expertise than Warren Buffett possesses. So, because he says he just can't read the big picture. And the best investors that I've read about in the world, Templeton, that's John Templeton, who's the company's named after him. He's the late John Templeton. Phil Fisher, of course, Benjamin Graham. They never went for sectors. They never went for the big picture. This is an invention of business schools. This is a philosophy that maybe is used by asset management companies to justify why they launch new unit trusts or new products into individual sectors. What you need to do when you're investing in shares is realize two things. One, you're a co-owner of the company. So that's the company that you're buying, not a sector. And two, you're buying shares in a company where those people who are managing the assets of that company are able to leverage those assets so that they can grow in excess of the economic growth rate. So what you're doing is you're actually buying intellectual capital. And you've got to buy cheap because you buy the assets that they're leveraging. So you need good management and you need good assets in that business. It's got to be in a good sector as well. All of that you will see when you have a look back and see what the track record of that company is, and clearly of the managers too. And you betting on those managers, it's like you're giving money to me. You invest in BizNews. You're giving money to me. I've got to take your money and make sure that I can apply it, that I can allocate that capital more efficiently than those people say in government. But I mean, that's a no-brainer. Maybe those people in other businesses. I can't give you a sectoral breakdown, David. Sorry. Okay, on to Google versus NASDAQ. Here's our star performer. Again, Amazon came out with results. Again, the market went dilly for them. And again, it helped our star performer in the portfolio to just keep getting better and better. We love Amazon. We loved it for the reasons that I've tried to articulate a moment ago. You have one of the smartest guys on earth in Jeff Bezos who runs this company. They are growing the business in an exponential rate. Amazon got past Walmart as a market cap some months ago, and it's just getting stronger and stronger. Last year, Amazon's turnovers were up 20%, 21%. This year, their sales are going to be up last year 20%, this year 20%, 21%, and that's in US dollars. They had a blowout quarter, a fantastic quarter. I suppose blowout means different things to different people. For the 3 months to the end September, remember, these American companies do come back to us and report every 3 months. In the quarter, they showed that their customers, imagine this for a business, your customers are up 13%. What your customers bought, they sold 26% more units through Amazon.com, and the existing customers, bought 11% more than they'd done the same time a year before. Operating profit, which the street thought was going to be $40 million, came in at $406 million. Gross margin, if you understand business, it's all about your margins. Gross margins, they were up 300 basis points to 33.9%. This is a very, very strong business. It's got its market sewn up, and where it's really making money now is somewhere where it's got a 7-year start on everybody else. In the cloud, Amazon Web Services has generated 78% more revenues. 78% more revenues in the year than it did the year before. And those revenues are now running at $8 billion a year. 80 billion rand. This is a great, not 80, it's more like, more like 110 billion rand. This is an incredible business, and now the traders would say to you, gee, you made 129%, cash in, put the money in the bank. Not on your life. You stick with this, baby. Let's go on to the 6-month graph. There you can see Amazon 43% growth as against 1.43. It seems to now be really, really hitting its straps. And when you look at the underlying story there, you can see that everything's pointing in the right direction.
Alec, just quickly, David Statler, he's looking for what shares that aren't in the portfolio. I think he's after that share you mentioned earlier.
No,
what do you like and at what price?
Irresponsible to even suggest it, David. I must stay within my circle of competence, and there's nothing outside the portfolio that's that I would even hazard a guess. Remember, you're buying at stocks. If you're an investor, what you buy is forever. Only time you sell the shares is when you've got something better to invest in, and then you must make sure that you know that it's a better investment, or if the guys who are running the company are crooks. So Buffett sold Tesco. He took a $450 million knock. He loved Tesco, a big UK retailer. But then he saw that they crooked the books. He sold, just dumped it. Said it's in a case like that, you just got to get out. There's nothing at the moment that we would. That's just not the way we operate. Okay, here's IBM. What I can say to you though, David, is that there are 3 stocks in our portfolio who are trading at lower than the prices we were prepared to buy them in at. So in other words, their margin of safety has improved still. And those 3 are IBM, Berkshire Hathaway, and
Apple.
Apple. And of the three, I love Apple the most. I just maybe Apple's just so big that people just don't understand how to value it anymore. But because it is the most valuable stock in the world. But Apple to me is an absolute standout investment. We get onto that in a moment. IBM came through in the quarter again. Here's a typical example of a value share that is out of favor with the market because the speculators have not done their homework and understood what is going on at IBM. IBM has got a very consistent, a very good process. They're going into the cloud in a big way. They're behind, unfortunately for them, Amazon, but they are still up there with Microsoft, so one of the big investors in the cloud. They took a decision in the business some years ago to shift it away from the existing businesses to new, or what they call strategic areas, which are now about 25% of the business already. So new, fresh areas that will be high growth areas into the future. They consciously sold off a lot of the business, a lot of the old IBM business. So the market or Wall Street doesn't like to see sales falling, but IBM selling off old, if you like, the antiquated parts of its company. So of course the sales are going to fall, but the important thing is the new areas that it's going in, those sales are growing at 30% a year. The biggest proponent, the biggest supporter of IBM is Warren E. Buffett from Berkshire Hathaway in Omaha. He is now the biggest shareholder individually in the company. He keeps acquiring stock. He is sitting on a paper loss of $1.7 billion. Buffett paid $169 on average for his shares. You can get them, as you can see, at $140. Do you need more of a suggestion, of a recommendation? I don't. There it is. IBM's trading at 140 at the moment, and in the past month, again, whereas when Amazon comes out with results and Google comes out with results, because Wall Street absolutely loves them, they move up. When IBM comes out with results, as you can see, the results recently released, it had a little bit of an uptick, but down again thereafter. They don't like this kind of company, do the desk jockeys on the street. But you should love it because it is the kind of business that you put away, and, well, we love it, and we're going to stick with it in the long term. Moving on to Novo Nordisk. This is one of the most fantastic businesses in the world. Google, I told you a little bit earlier, there's no way you can get into that or to try and unpack or to beat that business model is something that Warren Buffett and Bill Gates, two of the smartest investors on earth, have tried to do. Bill Gates, the founder of Microsoft. Buffett said at one of the AGMs in Omaha, it's not, we can't find a hole in their business. We can't find a way to puncture their bubble. And as a consequence of that, value investors of the 40,000 people who were in attendance went out and started buying Google shares, and they've done very well out of them. Novo Nordisk is in the same kind of category. Novo Nordisk owns 50% of the global insulin market. And with lifestyle diseases, people don't listen to Tim Noakes, unfortunately. If they did, we wouldn't have so many problems or Novo Nordisk. If the world converted to Tim Noakes, maybe that's the time to sell Novo Nordisk. But as long as we carry on with insulin and diabetes being a major problem, Novo Nordisk's strategy is going to be in the right direction. Their CEO has just won a huge award for being the best sustainable business in the world. I think that was provided by the Harvard Business Review. And as you can see, the share price, although it didn't do that great in the last month, still up by 6.5%. But when you have a look at it over the last 6 months, it's outperforming the market. And of course, in our portfolio with the Rand kicker, it's 50% stronger. We love Novo Nordisk. Shall we get on to that last question, Stuart?
It's a statement, I think, from, sorry, just get the name here. Andy, it's on Apple. You're saying Apple should buy Amazon or Google. I'm not sure.
Okay, Alan. Yeah, Amazon. Amazon's not for sale. Bezos ain't selling it. And Google, I'll tell you an interesting story about Google. Between the three holders, because they have a different share structure, so they've got a voting shares and high voting shares and low voting shares. Between Larry Page, Sergey Brin, and Eric Schmidt, they own 60% of the votes. So Google, Alphabet, ain't for sale. But look at this one. I just love this business. Apple came out with financial results in the quarter. It did help this time round. The results went up. But any way you want to look at Apple, just everything is going in the right direction. I think maybe what the street is worried about is that perhaps they don't believe that Apple can continue to achieve or to deliver what it has been delivering. In the year to September, the 3 months to September, the quarter was the final quarter. So in the year to September, this company generated a growth in its bottom line of 30%. It's just going in the right direction. Revenues were up 28%. It sold 231 million iPhones, as against 169 million the year before. Those iPhones now, you cannot get an iPhone 6S or the big one, iPhone 6S Plus they call it. You can't get them anywhere at the moment unless you're on a long waiting list. The App Store, which is a part of the whole ecosystem that the great entrepreneur Steve Jobs understood and put together, that's hitting new records. Apple Watch is now exceeding expectations of the people internally. Their revenues in China were double year on year. This is a company that's on a rip. The only thing that isn't on a rip is the share price. And as you can see, in the past 6 months, Apple has underperformed the NASDAQ index. It's down by 7.25% in the past 6 months, whereas NASDAQ is up by 1.5%. Apple is, they bought back 330,000 shares, or put it in a different way, $35 billion in the past year. So they've given back to shareholders $35 billion through share buybacks this year, $45 billion last year. They're continuing to buy shares when the shares are cheap, which they are at the moment. And that is one way, in addition to dividend payments, that Apple is giving its shareholders part of the incredible success story that it's achieved. Why doesn't the market like Apple, or why do they not give Apple a better rating than many of the other companies in the similar sector? Maybe they don't believe the story. Maybe they believe that Apple's going X growth. Maybe they believe or don't actually understand exponentiality and the network effect, two of the big stories for new economy companies. Those are the if you get that, if you get the network effect, in other words, the more people you've got in your ecosystem, the more people that you revolve around each other, like with Amazon.com. They've got all those customers now. The customers are being given other options. They've grown the customer basket 11% in the past 3 months because of those options, because of the network effect. Amazon's a great example of it. Apple's another great example of it. And so is Google, another example of it. As is IBM. Remember, IBM supplies into virtually all of the Fortune 500 companies. So these are its customers. What it's now doing is it's taking those customers and helping them to go into the new economy, the network effect. If there's one way, if you like, that exemplifies this portfolio, it is the network effect. And that's what you have to kind of understand to realize why some of these shares are performing the way that they are. Well, I hope that you've enjoyed the discussion today. Thank you for all the questions. I also appreciate the feedback. Thanks. There's quite a few guys who've thanked us for it, for the responses. Just to again overlay the situation that we're at in this portfolio, we've been helped a great deal by the rand, but that was a conscious decision to go offshore rather than to stay onshore. It's something that I believe you need to continue going with. The other thing that if you have a look at the various constituents of the portfolio, remember, we've bought them all forever. We're not wanting to sell these shares. At some point in time, it could be a situation where we find something better, and then we will swap some of them, but we're not going to sell Amazon, even though it's our best performer. Where we will be changing, perhaps, would be when we find the new investment, we would sell part of the index fund, the overall index, and allocate part of that resource into it. But even with the index fund, thanks to the rand, that's up 24%. Next month we will be coming to you, I think, similar day.
Yeah, similar time, November.
Right at the end of November, and then we'll be very close to being 1 year. The portfolio would have been in place for 1 year. So thank you, everybody, for sacrificing your... I see, Paul, you said there, thanks for a great presentation, worth sacrificing your time for. Well, we appreciate investing, or hopefully it wasn't too much of a sacrifice, but the investment of your time, and we look forward to being back in your company again. Remember, we do cover all of this, the portfolio, to a large degree as we go through BizNews every day. We're up early. Stuart and I are finding the great stories to do with this portfolio and how the performance is. So keep visiting us on biznews.com, and you'll be we'll keep supporting you in every way we can. Thanks again. We look forward to being back with you next month.
Yeah, thanks. Cheers, Alec.